let's jump right into today's explainer. We're breaking down a seriously volatile overnight session where global macro signals, geopolitical realities, and market reactions are basically colliding head-on. If you're navigating the financial markets today, you absolutely need to understand what just happened yesterday and exactly how the technical levels are setting up right now. So let's get into it.
Right, so the main catalyst for all this morning's macro volatility, it's that shocking drop of 23,000 in July US payrolls. I mean, negative 23,000. And when you pair that with muted wage growth and actually improving productivity, the immediate market reaction was pretty fierce. It abruptly cooled any lingering expectations for a September Fed rate hike. Risk assets had a really strong week up to this point, but beneath the surface, the macro picture is suddenly looking a whole lot less comfortable.
And you can really see this tension when you look at the stark divergence happening right now between Wall Street and Main Street. On one hand, institutional investors still have this voracious, almost insatiable appetite for AI tech. Alphabet just raised $25 billion through a bond issue that was oversubscribed 4 times over. But then you look at Main Street, and corporate earnings from giants like McDonald's are providing a pretty harsh reality check. The lower-income consumer is actively pushing back on cumulative price increases. They are showing severe spending fatigue now that those pandemic-era savings have completely dried up.
I absolutely love this quote because it beautifully summarizes our current macro reality. With this incredibly uneven economic expansion, we've got European retail sales disappointing, China's manufacturing stuck in contraction territory. It proves that data and markets no longer feel obliged to travel together. Tech stocks are just charging higher, completely ignoring the underlying fundamental data. Okay, adding fuel to the fire, let's check in on the commodity triad and our geopolitical wildcard, the Middle East. Now, initially, oil eased a bit on hopes of a US-Iran agreement regarding the Strait of Hormuz, but those hopes hit a brick wall. We saw fresh compensation demands from both Trump and Tehran, plus Iran just appointed new senior military commanders. Because this so-called de-escalation has completely stalled out, Brent crude is stubbornly climbing back above $87. Meanwhile, gold is aggressively pricing in lower Fed rates, hitting a 9-week high near $4,377. All right, Section 2, Global Majors. Let's funnel this high-level macro view down into actionable, tactical, technical levels for the major currency pairs. Starting with the dollar index, that M pattern is holding as a clear tactical sell-on rise. Support at 99.64 is holding up for now, but keep your eyes glued to today's ADP jobs data. That weekly pivot at 98.48 is your critical level to trigger a full structural breakdown on the dollar, with further support resting at 99.00 and resistance capping things at 100.25. Meanwhile, looking at Eurodollar, it remains a solid buy on dips. It's getting some help from a weaker dollar, sure, but gains are being capped by those energy price concerns we talked about. Plus, German 10-year bund yields have crept up to 3.18% amidst some incredibly sticky EU fiscal negotiations on how to actually finance defensive energy corridor naval deployments. Over to cable, and we are seeing some classic roiling volatility driven by those energy shocks and fiscal uncertainty. Get this, UK 10-year gilts actually hit 5% over the past 24 hours. There's no major UK data today, so the structure holds as a buy on dips, with lower support at 1.3450 and overhead resistance at 1.3558. Now looking at Japan, it's actually Mountain Day today, so we have a market holiday, but USD JPY has already surged 4 yen right off its recent intervention lows. It's back to a buy on dips setup on the daily time frame. We're looking at support layers holding at 158.93 and 158.35, targeting resistance up at 159.77. The Bank of Japan is just in an impossible bind right now. They literally cannot fight inflation and protect their fiscal position at the exact same time. Next up, let's shift our focus over to the Indian markets, specifically the Nifty and the Rupee. We are seeing a very delicate balancing act playing out here. The Rupee eased slightly to close at 95.30, but it definitely retains a sell-on-rise structure. It actually defied some of that rising oil pressure, mostly thanks to suspected RBI intervention via PSU banks stepping in to sell dollars. Weekly support at 94.87 is holding really firm, alongside near-term support at 95.21, with the resistance sitting at 95.43 and 95.63. On the equity side, despite that oil pressure, the Nifty 50 retains a buy on dips structure. Equities actually managed to close marginally higher in a pretty choppy session where small caps fell but mid caps gained. Resilient earnings are doing a lot of heavy lifting to offset the oil drag here. So if the Nifty holds above the 24,561 mark, your next upside target is 24,811. But if it breaks below, watch for downside support at 24,344.
All right, let's zoom out and look at the timeline for the week ahead. We have a massive barrage of data about to drop that will absolutely dictate the near-term trend. Tomorrow's US CPI and PPI prints, that's the main event, guys. A softer print basically locks in a Fed hold for September, but if it comes in hot, it's going to instantly inject fresh yield volatility into the market. We're also getting crucial US retail sales and jobless claims to really gauge consumer health, plus major growth and trade data from the EU, Japan, China, and India.
Which brings us to the critical takeaway for your trading desks today. The markets are absolutely craving rate cut certainty right now. But when you weigh that against the severe energy flow vulnerabilities in the Strait of Hormuz and sticky inflation data looming right around the corner, which wildcard is going to shatter these current technical ranges first? That is the million-dollar question. Keep a very close eye on those pivot levels and stay nimble out there.